4 days from now, the Bank of Japan can trigger a shift in global liquidity conditions, and Bitcoin historically reacts quickly. Many market participants will treat it as background information, then question why volatility suddenly accelerates. And I don't want you to be wondering. So today, I want to explain why Japan still matters for global liquidity, why thin market depth makes Bitcoin more reactive, and why institutions continue building crypto market infrastructure even as attention fades. So by the end of today's video, you'll have a clear framework for navigating the next several days. So without further ado, let's start with Japan. On December 19th, the Bank of Japan is widely expected to raise rates by 25 basis points. That move matters because it directly affects the cost of yen funding across global markets. For years, the yen has functioned as a primary funding currency. When funding costs are low, global investors borrow yen and allocate capital into higher yielding assets, including, for instance, equities, credit, and crypto. When Japan tightens, those funding costs rise quickly, and positions financed through yen borrowing are often reduced simultaneously. And there is a second layer that amplifies this effect. Japan holds approximately $1.1 to $1.2 trillion in US Treasuries. So changes in Japanese monetary policy can influence Treasury yields and global dollar liquidity conditions. Those shifts propagate rapidly through equities, credit markets, and Bitcoin. Historically, Bitcoin has responded sharply following recent Bank of Japan tightening events. After the March 2024 hike, Bitcoin declined roughly 23%. After July of 2024, about 26%. Following the January 2025 adjustment, roughly 31%. These moves reflect how quickly leverage can be reduced when funding costs rise and risk assets are repriced. There is also a longer-term signal embedded in Japan's balance sheet strategy. The Bank of Japan holds roughly 83 trillion yen in equity ETFs, approximately $534 billion, and plans to begin a gradual reduction as early as next month. The proposed pace, roughly $2 billion per year, is designed to minimize market disruption. Even so, it represents a structural transition away from extraordinary monetary accommodation and signals reduced marginal support over time. Taken together, the setup into December 19th is clear. Higher yen funding costs, potential carry trade deleveraging, and an environment where market sensitivity to liquidity changes is already elevated. Now let's widen the scope, because Japan's decision coincides with the heavy macro data window. The same period also features a dense U.S. economic calendar. Retail sales, employment data, PMI surveys, CPI, and core PCE are all scheduled within a narrow window of time. Core PCE is the Federal Reserve's preferred inflation metric, and these releases shape expectations for monetary policy into 2026 next year. Crypto tends to behave like a high beta liquidity asset during periods like this. When economic data moves interest rates and treasury yields, the impact flows across risk assets. Even when Bitcoin appears stable, repricing can happen quickly once macro data shifts expectations. Recent market behavior reflects this environment. Thin participation, shallow order books, and short-lived rallies are typical when liquidity conditions tighten. In that context, macro headlines carry outsized influence. So the key question becomes, how resilient is Bitcoin's market depth right now? That brings us to the on-chain liquidity indicators. One indicator worth watching is the Inter-Exchange Flow Pulse, or also known as the IFP. This metric tracks Bitcoin's transfers between exchanges, offering insight into how actively liquidity is rotating across trading venues. When inter-exchange flows decline, effective market depth tends to shrink, making price more sensitive to marginal order flow. And currently, this signal has turned negative. At the same time, exchange balances are near historic lows, meaning fewer coins are readily available for trading. A useful comparison is a commodity market with limited supply near the best bid and offer. When depth is abundant, large orders are absorbed with minimal price impact. When depth is thin, though, even moderate orders can push price sharply in either direction. And this is the current Bitcoin environment. This dynamic also explains rising stablecoin dominance. Stablecoin dominance measures the share of crypto market capitalization held in dollar-pegged assets. When that share rises, it indicates capital is positioned defensively rather than allocated towards risk. That aligns with the muted follow-through we've seen since the recent pullback. Structurally, Bitcoin continues to struggle to reclaim the mid to high $90,000 range, roughly $95,000 to $97,000. That area has acted as persistent resistance. On the downside, the low 70 range remains a key zone where demand could emerge in a deeper drawdown. In thin markets, moves into that area can be abrupt, and early rebounds often reflect short covering rather than durable trend shifts. That is the current market structure. Now let's examine the behavioral backdrop because sentiment is stretched while liquidity remains constrained. Google search interest for crypto is near 5-year lows. Outside core market participants, attention has largely disappeared. Engagement drops, headlines lose traction, and participation thins. At the same time, sentiment indicators show elevated fear. The fear and greed index remains deep in extreme fear territory. Historically, these conditions often coincide with transitional phases, though fear can persist longer than expected. This reinforces the importance of positioning rather than short-term forecasting. Longer-term momentum indicators also reflect exhaustion. Weekly RSI is near levels observed during prior stress periods, including the late 2018s, March 2020, and mid-late 2022. RSI compression typically suggests selling pressure has already expended significant momentum. When thin liquidity, low attention, and elevated fear converge, markets become more reactive. That is why weeks involving major policy decisions, such as this one from the Bank of Japan, often feel destabilizing, so be prepared for that. At the same time, outside short horizon price action, longer-term structural development continues. While short-term price signals dominate daily conversations, as I'm sure you're all aware, institutional market infrastructure continues to advance, and that's critical in the actual pulse of life of this industry. We see Visa is launching a stablecoin advisory initiative aimed at helping banks evaluate stablecoin applications. Given Visa's role at the center of global payments, this reflects institutional demand for digital settlement assets that operate within regulatory and compliance frameworks. Stablecoins function as cash equivalent instruments that move continuously, settle quickly, and integrate efficiently with modern payment systems. In capital markets, JPMorgan is moving towards launching a tokenized money market fund on Ethereum. Money market funds are a primary vehicle for institutional cash management. So tokenizing these instruments allows cash-like assets to settle on-chain and integrate directly with digital collateral frameworks. This reinforces the narrative of Ethereum serving as a foundational settlement layer for institutional finance. Large financial institutions build on networks that can support scale, reliability, and regulatory alignment. As tokenized cash and stablecoin issuance expand, decentralized finance becomes more relevant. DeFi refers to on-chain lending, borrowing, and trading protocols. Improved collateral quality and settlement efficiency strengthen on-chain markets and support gradual increases in real economic activity across crypto ecosystems. Even during periods of defensive positioning, these structural developments continue. We also see that Strategy recently acquired 10,645 Bitcoin for approximately $980 million at an average price near $92,000 per coin. Total holdings now exceed 671,000 Bitcoin, representing roughly 3.2% of Bitcoin's fixed supply. This matters because long-term Treasury accumulation removes supply from the actively traded market and secures Bitcoin's price long-term for everyone. Combined now already with low exchange balances, available liquidity can tighten faster than expected. Price action can remain volatile during periods of forced selling. However, once that pressure subsides, price adjustments can be swift due to constrained supply. So, heading into December 19th, the framework is consistent. Liquidity is limited, on-chain flow indicators remain weak, sentiment is defensive, and institutional market infrastructure we see continues to expand. Corporate treasuries continue to accumulate too. So let's close things out. In a nutshell, the next several days revolve around liquidity conditions. The Bank of Japan's decision on December 18th and 19th can tighten funding dynamics, while U.S. economic data can shift rate expectations in the same window. So in a market where Bitcoin's depth is already limited, that combination is what produces larger than expected moves. So once again, be aware of this. The objective here at my channel and in general and for everyone watching is not to predict short-term price action. It's to understand the structural forces driving it so that you know how to position yourself long-term. And if you've been tuning here to my channel for the past videos or the past few months, then you would know how I feel, and you would know that all of the data points to a Bitcoin going to over $1 million in the near future. So all we have to do right now is hodl. That's it. I love you guys so much. That's a wrap for today's video. I'll catch you guys here tomorrow.